9 times more Bitcoin than miners produced. That's what Wall Street absorbed in just 8 days. And the financial press is calling it a cautious recovery. Welcome to the Bitcoin Report. I'm AI Ryan Matta. The real Ryan put this script together this morning, then his day got away from him. So I'm here to walk you through it. Today's story is the Bitcoin ETF inflow report that dropped fresh on CoinDesk this morning. And it's one of those stories where the headline and the reality are pulling in two different directions. We're going to go through both the numbers, the context, the macro environment, and what any of this actually means if you're a Bitcoin holder sitting there wondering whether this market is building or just bouncing. Let's get into it. The headline number is $629.8 million. That's how much flowed into US spot Bitcoin ETFs in a single day on May 1st, one day. That's one of the biggest single day inflow figures the Bitcoin ETF market has recorded in all of 2026. BlackRock alone put up $284.4 million of that. Fidelity added $213.4 million combined. Those two firms accounted for more than 79% of the entire day's inflows. And this wasn't a one-off event. It came at the end of April, which itself was the strongest month for Bitcoin ETF inflows all year, with $2.44 billion flowing in over the course of the month. So on the surface, this looks like a clear bullish story. Institutions are back. The money is moving. Bitcoin is getting bought up at scale by some of the largest asset managers on earth. And that part is true. But CoinDesk piece this morning, which is the anchor story today, was titled, "The Bitcoin ETF Recovery is Real. It is just not complete yet." And that framing deserves a closer look because it tells you something important about where we actually are. Here's the part that's getting buried under the big monthly numbers. Cumulative net inflows into US spot Bitcoin ETFs since they launched in January 2024 now stand at $58.72 billion. That sounds massive, and it is. But the all-time peak was $61.19 billion, which was hit back in October of last year. We are still $2.47 billion below that peak. And before this 2-month recovery run started, from November 2025 through February 2026, these ETFs bled $638 billion in outflows. So the $329 billion that came back in over March and April hasn't fully plugged the hole. It's real progress. It's meaningful. But calling it a full recovery overstates where we are. This matters because the narrative shapes behavior. When people hear Bitcoin ETFs hit record inflows, some of them interpret that as a signal that the coast is clear, that institutional conviction is fully restored, that the market is back at peak strength. The more accurate read is that institutions are coming back in a measured, deliberate way, and we're somewhere in the middle of a recovery arc, not at the end of one. Now let's talk about who specifically is doing the buying, because the composition of these inflows is as important as the volume. BlackRock's iShares Bitcoin Trust, ticker IBIT, is the dominant force in this market. It now holds more than 810,000 BTC. To put that in perspective, that is roughly 3.8% of Bitcoin's entire circulating supply sitting inside one ETF managed by one company. BlackRock manages over $50 billion in Bitcoin-related assets at this point, and during a single week in late April, IBIT captured about 75% of all Bitcoin ETF inflows across the entire market. One fund, 75%. That level of market dominance is remarkable, and it tells you that when institutional allocators decide they want Bitcoin exposure, they're overwhelmingly going to IBIT as the default vehicle. Fidelity is the clear number 2. Their FBTC product has been consistently strong. And then there's a new entrant worth paying attention to. Morgan Stanley launched its own Bitcoin Trust ETF on April 8th. It pulled in $194 million in inflows during April and did not record a single day of outflows during the month. Morgan Stanley entering the Bitcoin ETF space as an issuer rather than just recommending existing products to clients is a meaningful shift. It's a major wireframe brokerage, deciding that the demand from their client base is large enough and persistent enough that they need their own product. That's not a firm dipping its toe in. That's a firm making a structural commitment. And here's something worth sitting with. On April 23rd alone, Bitcoin ETFs collectively absorbed roughly 19,000 BTC. In that same 8-day stretch, Bitcoin miners produced somewhere around 2,100 BTC. So the ETFs were buying approximately 9 times more Bitcoin than the entire global mining network was producing. That imbalance between institutional demand and new supply is the most important structural dynamic in this market right now. You can debate price targets, you can argue about resistance levels, but when the buy side is consistently outpacing new supply by that kind of ratio, the long-term direction of that math is not complicated. Now let's bring in the macro context because Bitcoin doesn't exist in a vacuum and the backdrop right now is genuinely unusual. The Federal Reserve held rates steady this week at 350 to 375%. That in itself wasn't surprising. What was surprising was the number of dissenting votes on the committee. 4 members dissented, which is the most dissenting votes on an FOMC decision since 1992. That's not a minor footnote. It means the committee is not unified. There's internal disagreement about what policy should look like from here. And that uncertainty ripples out into every risk asset market, including Bitcoin. On top of that, Jerome Powell's chairmanship at the Federal Reserve ends on May 15th. Kevin Warsh is expected to chair the June FOMC meeting. Warsh is publicly known for favoring tighter monetary policy. Tighter policy generally means higher rates for longer, which historically puts pressure on risk assets. Markets are going to be watching the June meeting very carefully. It could inject real volatility into Bitcoin's price in the weeks ahead. Then there's the oil situation. Brent crude is sitting around $107 to $111 a barrel, depending on the day. Iran has been blocking the Strait of Hormuz, which is one of the world's most critical shipping routes for oil. The U.S. Navy is stopping Iranian crude exports. There were reports this week of Iran sending a new proposal to restart negotiations with the U.S., which pushed oil slightly lower, but the underlying tensions haven't resolved. Elevated oil prices feed into inflation. Inflation makes the Fed's job harder, and a Fed that can't pivot to cuts is a headwind for Bitcoin in the short term, even as the long-term thesis for Bitcoin as an inflation hedge gets stronger. There's also a positive regulatory development that didn't get enough attention this week. The Senate reached a compromise on stablecoin yield legislation, which removes what had been a significant roadblock to broader crypto market structure legislation in the US. Bitcoin is not a stablecoin, but the regulatory framework that governs crypto markets affects Bitcoin directly. Every step toward clear, workable regulation in the US reduces uncertainty for institutional allocators. Reduced uncertainty means more of them are willing to add exposure. It's a slow-moving tailwind, but it's real. Bitcoin's price right now is hovering just below $80,000. That level has become the most watched number in the market. Bitcoin approached $80,000 earlier this week and got rejected. It tried again on Thursday and stalled. The $80,000 level is being treated as a key psychological resistance point. Analysts are saying that a decisive break above it could draw in a new wave of buyers who have been sitting on the sideline waiting for confirmation. A failure to break through, especially if it coincides with a broader market risk-off move, could trigger some selling from leveraged positions that got built up during April's rally. The setup at $80,000 is genuinely binary in the short term. But here's what the short-term price action can't tell you: the behavior of the long-term holders. Bitcoin's derivatives market this week is showing low implied volatility, negative funding rates, and options positioning that leans slightly defensive. That's not the fingerprint of euphoria. That's the fingerprint of a market where the large, serious players are hedged and cautious even as they continue to accumulate. The speculative froth that usually shows up at cycle tops is not present in the current data. That's a meaningful data point. Let's talk about what ARK Invest said this week, because it ties the short-term noise directly to the long-term thesis. ARK published their Big Ideas report, and their Bitcoin price target by 2030 is a market cap of $16 trillion. For context, Bitcoin's entire market cap right now is roughly $1.6 trillion. A $16 trillion market cap, if all 21 million Bitcoin were in circulation by then, which they won't be, would imply a price above $730,000 per coin. ARK has previously published a range of $300,000 to $1.5 million by 2030. The $730,000 figure from this week's report sits conservatively within that range. The driver's ARK is pointing to include continued ETF adoption, growing corporate treasury allocations, sovereign wealth fund interest, and Bitcoin's emerging role as a neutral reserve asset. On that last point, they flagged that even a 0.5% allocation from global monetary reserves, which they estimate at $68 trillion, would add roughly $339 billion in demand. These are big speculative numbers over a 4-year time frame. But the institutional infrastructure being built right now, the ETFs, the Morgan Stanley product, the BlackRock dominance, the regulatory framework taking shape, this is what that adoption path actually looks like in its early stages. What's happening with ETF flows today is not separate from the $730,000 scenario. It is the beginning of the mechanism that gets there. And the scarcity angle keeps getting sharper. Bitcoin supply is fixed at 21 million. We will never produce more. The most recent halving cut the block reward in half, which means the daily flow of new Bitcoin into the market dropped by 50%. Every day that institutions buy 9x more Bitcoin than miners produce, the float tightens. Long-term holders are not selling at these prices. On-chain data consistently shows coins held for more than a year, barely moving. The coins that are trading are mostly shorter-term positions. The structural setup for a supply squeeze gets more pronounced with each month of strong ETF inflows. The nuance in today's story is that we're not at the finish line. The $638 billion in outflows from November through February left a real crater. 2 months of positive flows and $329 billion in inflows have partially filled it. The full cycle story here is not over, but the direction of travel is clear. The institutions that left came back faster and with more conviction than most people expected. BlackRock and Fidelity were absorbing selling pressure from smaller funds the whole time, which tells you the largest players never lost confidence. They used the weakness to accumulate. If you are a Bitcoin holder, the honest read on today's story is this: the recovery is real. It is institutional. It is supported by supply dynamics that are structurally favorable. And it is happening against a macro backdrop that is uncertain enough in the short term to create volatility, but supportive enough in the medium term that the serious money is not going anywhere. The $80,000 resistance level is the immediate test. The 2-month ETF recovery arc and whether it can close the gap back to October's peak is the medium-term story to watch. And the long-term story, the one ARC is telling and the one the supply math supports, is playing out exactly the way Bitcoin's design intended. That's the full picture for today. If this kind of breakdown is useful to you, subscribe to this channel. We do this every day, covering the Bitcoin stories that matter and cutting through the noise. And if you want to go deeper on your own Bitcoin strategy, head over to bitcoinmaxing.com. Ryan built a free Bitcoin retirement calculator there. You put in your numbers, your timeline, your current stack, and it shows you what different price scenarios could mean for your financial future. It's free, it's Bitcoin only, and a lot of people have found it genuinely useful. That's bitcoinmaxing.com. Go check it out.